Yes, good morning, everyone. I hope you are able to see the screen, all of you. Okay. So let's start with the analysis of the second part of the Economic Survey 21-22. In the last class, that is the last weekend, we had covered two important chapters from the Economic Survey. That is the first chapter and the second chapter. As part of the first chapter, we understood as to what was the theme of this year's Economic Survey. So we discussed the concept of the Agile Approach and the barbell strategy. Then in the second chapter, we had looked at the overall status of the public finances with respect to the share of direct taxes, indirect taxes, and so on. As far as this particular class is concerned, in this particular class, we shall be discussing the other chapters from the Economic Survey, starting with chapter 3, that is the external sector. In this particular chapter, first and foremost, we'll look into certain basics of balance of payments. Then we'll have a snapshot of balance of payment, concepts of the international investment position, that is NIIP, present status of India's external trade, the overall trends of FDI into India, India's forex reserves, India's external debt, and more importantly, we'll understand the concept of taper tantrum and its impact on the Indian economy. See, before starting with the analysis of any chapter of the Economic Survey, you first have to look at the nature of questions which have been asked in the previous year prelims examination. Based upon the analysis of the nature of questions asked in the previous year prelims examination, we can approach the Economic Survey in the right direction. This becomes quite important because, as you know, the Economic Survey, it is filled with a lot of facts, a lot of figures, which are actually not important from the perspective of the UPSC Prelims examination. So you need to approach the Economic Survey in the right approach that is according to the requirements of the UPSC examination. So as far as this particular topic is concerned, that is the external sector, this is a topic which has been getting the maximum weightage as far as the UPSC Prelims examination is concerned. And from this particular topic, repeatedly questions have been asked with respect to various aspects, such as what is the balance of payment, the components of balance of payment, that is the components of the current account and capital account, then present status of India's external trade. Questions have also been repeatedly asked with respect to India's forex reserves. So based upon the analysis of the previous year question papers, these are the topics which become important as far as this particular topic is concerned. So if you have a look at the previous year questions, as you can see in prelims 2013, we had this question about what exactly is balance of payment, that is BOP. Then once again, a question related to which among the following constitute the capital accounts under the BOP. And then this question related to which among the following constitute the current account. So based upon the analysis of the previous year UPSC questions, let us have a brief discussion about the balance of payment, that is BOP. See, when you look at the balance of payment, that is BOP, it is a record of all the economic transactions that takes place between the residents and non-residents of a country for a period of 1 year. So for a period of 1 year, whatever economic transactions take place between the residents and non-residents, all of these transactions get recorded into the balance of payment. So as part of balance of payment, whenever the foreign currency comes into India, that it is denoted as positive, that is inflows. And whenever the foreign currency goes out of India, it is denoted as negatives and it is considered as outflows. And if you look at the balance of payment, as I said, it's an annual flow of how much money is coming into India and going out of India. So as on March 31st, that is when the financial year ends, the balance of payment could either be positive or it could be negative. For example, if the overall inflows is more than the outflows, then obviously balance of payment would be positive. On the other hand, if the overall outflows is more than the overall inflows, then the balance of payment would be negative. This is as on March 31st. That is once the financial year ends. But on April 1st, that is once the financial year actually starts, that time the balance of payment starts with a clean slate, which means as on April 1st, the balance of payment would be equal to 0. So please understand this, that balance of payment keeps a record of all the economic transactions between the residents and the non-residents. Is there any disturbance in the mic? Raman? Pragati? No, right? So let's have a look at the balance of payment, that is BOP. So as you can see, BOP, it is a system of record of all the economic transactions between the residents and non-residents for a period of 1 year. Whatever money comes into India, it is denoted as positive. Money going out of India, it is denoted as negative. Now within balance of payment, you have two accounts, that is the current account and the capital account. Within current account, once again, you have two accounts, that is balance of trade and balance of invisibles, BOT and BOI. When you look at balance of trade, it basically covers trade only in terms of goods. It does not cover trade in services. Please remember this. As far as trade in services is concerned, it is part of balance of invisibles. So BOT covers only the goods. And as you can see there, balance of trade, it is calculated as total value of exports minus total value of imports. So if my exports is more than the imports, then the balance of trade would be positive. On the other hand, if the exports is lower than imports, then the balance of trade would be negative. One important thing which I'm going to tell you here is, this year Economic Survey has published the statistical appendix. Normally every year it publishes a statistical appendix, but this year, if you look at the statistical appendix published in the Economic Survey, there, if you look at the overall trends with respect to balance of trade, that is BOT, you will find that since 1947, that is since the time India gained independence, almost like 99.99% times, most of the years, the balance of trade has always been negative, almost like 99.99% times. Only like 3 to 4 years since 1947, the balance of trade for India has been positive. Only for 2 to 3 years, like 1972, 1974, and so on. Don't have to remember the actual years in which the balance of trade was positive. But what you need to understand is that since 1947, most of the years balance of trade has been negative. Only for 3 to 4 years, balance of trade has been positive for India. More importantly, since 1991 economic reforms, BOT for India has always been negative. It is always negative for India since 1991 LPG reforms. So please understand this particular trend as far as balance of trade is concerned. Next, as far as the balance of invisibles is concerned, here we take into account the net export of services, which is once again denoted as total export of services minus total import of services, net of income, that is profit, interest, and dividend, and net transfers, which include remittances, donations, and gift. As far as balance of invisibles is concerned, this particular account, usually it is in surplus for India. So balance of trade, it is usually in deficit, whereas balance of invisibles, it is usually in surplus. The reason being, India is one of the largest exporter of services. So when you look at balance of trade, that is usually in deficit for goods. But when you look at the services, it is in surplus because we export more than what we import. Apart from that, if you look at these remittances, right, particularly this part, see, World Bank publishes a report known as Development and Migration Brief Report. The Development and Migration Brief Report basically highlights as to how much remittances different countries across the world are receiving. And according to the latest report, India receives the world's highest remittances. In fact, it is far higher than that of China. So in terms of absolute value, India gets the world's highest remittances, which is approximately around $80 billion. And in terms of percentage of GDP, that is, if you convert the remittances into percentage of GDP, this is approximately equal to 3%. One thing which is important here is, in terms of absolute value, India receives the world's highest remittances. But in terms of percentage of GDP, it is not India. Rather, in terms of percentage of GDP, the countries which receive highest remittances are usually the smaller economies. For example, you have a country called as Tonga. This country receives the world's highest remittances in terms of percentage of GDP. So once again, important from the perspective of the prelims examination, remember the Migration and Development Brief Report, it is published by World Bank. Second, in terms of absolute value, India receives the world's highest remittances. And in terms of percentage of GDP, it is not India. It is rather smaller economies such as Tonga. And as far as from which country does India receives the world's highest remittances, it is basically from the Gulf countries such as Saudi Arabia, UAE, and so on. So please remember these things. So usually in case of India, as I said, balance of trade, this is negative, whereas the balance of invisibles, it is positive. So when you look at the current account could either be positive or it could be negative. It becomes positive when the balance of trade negative value, this is lower than the balance of invisibles positive value. So if this positive value is higher than balance of trade negative value, then we will have current account surplus. On the other hand, if the balance of trade negative value is more than the positive value on the balance of invisibles, then the current account will be in deficit. As far as the capital account is concerned, in the capital account you have FDI, foreign direct investment, foreign portfolio investment, external commercial borrowings, and loans from multilateral institutions. So usually in case of India, the capital account is in surplus. So now if you look at the general trends, that is with respect to BOP, with BOP there are two possibilities. One, the balance of payment could be negative or it could be positive. The BOP could become negative when the current account deficit, as I said, this account is normally in deficit. If this deficit value is higher than the capital account surplus, then the balance of payment would be negative. On the other hand, if the capital account surplus, if this is higher than the current account deficit, then the balance of payment would be positive. So what do you think is India's balance of payment, positive or negative? You need to understand the general trends as far as BOP is concerned, whether the BOP has been increasing or decreasing, or whether the BOP is positive or negative. So here I have compiled the trends with respect to BOP. So as you can see here, in the year 2017-18, the BOP was positive, $43 billion. Then next year, the BOP was negative. Next year, that is in the year 2019-20, the BOP was positive. And now in this year, the BOP is expected to be more than $87 billion. That is positive. Don't remember these facts and figures, but remember that as far as balance of payment is concerned, there is no consistent increase or consistent decrease in BOP. The BOP as such is fluctuating. Please remember this from the perspective of the prelims examination. Second point is, in the last 4 to 5 years, maximum number of times BOP has been positive, but in 1 year the BOP has been negative. If you remember this, that's more than sufficient. So if at all you get a question or a statement in the UPSC Prelims examination that the balance of payment has been positive for India in the last 4 to 5 years, the statement would be wrong, because for 1 year the BOP was negative. Similarly, if you get a statement that BOP of India has seen a consistent increase or a consistent decrease, the statement once again would be wrong. So you just have to remember the general trends as far as BOP is concerned, right? Now, apart from that, the trends with respect to BOT, balance of trade. Please remember this very important aspect. That is, since India's independence, that is since 1947, balance of trade for India has been negative for most of the years. Only for 3 to 4 years, the balance of trade has been positive. Since 1991 reforms, once again, balance of trade has been negative. Apart from that, if you look at the current account, this, see, last year, the current account was in surplus. Last year, current account was in surplus for the first time in the last 17 years. The current account had become surplus. But as far as this year is concerned, the current account is expected to in deficit. So please remember this particular aspect also. The current account last year was in deficit, but this year it was surplus last year, and this year it is expected to be in deficit. So these are the things which you must understand as far as the BOP is concerned. Apart from that, there is nothing else you have to remember as far as the BOP is concerned. Just remember these important trends. That alone should be sufficient, right? Okay. Now look at the practice question. Look at the practice question number 1 and let me know the answer. With reference to balance of payment, consider the following statements. The balance of payment has consistently remained positive for India in the last 5 years. India's merchandise trade balance has been in deficit since 1991 reforms. India has never witnessed current account surplus since 1991 economic reforms. What do you think is the answer? First one, the balance of payment has consistently remained positive. Statement is wrong. India's merchandise trade balance has been in deficit since 1991 economic reforms. Yes. India has never witnessed current account surplus since 1991 reforms. As I said, last year, India actually witnessed a current account surplus. So the statement which is given here is wrong. So right statement would be 2 only. So that is how questions can be expected in the prelims examination. Look at the practice question number 2. Let me know the answer. Which among the following steps can be taken to reduce the current account deficit in India? What do you think is the answer? Which among the following steps can be taken to reduce the current account deficit? Options are increase in customs duty, reducing logistic costs, cancelling all the free trade agreements, FTAs. Now please focus here. Option number 1 is increase in customs duty. So can I say by increasing the customs duty, we would be able to reduce the import of certain non-essential goods, right? By reducing the import of non-essential goods, we would be able to reduce our current account deficit. So first statement is right. Second, by reducing our logistic cost, we would be able to boost our exports. By boosting our exports, we can reduce the current account deficit. This is right. Now look at the third statement. Third statement says cancelling all the free trade agreements, FTAs. See, as far as India's experience with the FTAs is concerned, India's experience with the FTAs has been a mixed bag. Because on one hand, the FTAs which we have signed with smaller economies such as say Nepal, Sri Lanka, etc. By signing the FTA with these smaller economies, our exports are more than our imports. So our current account deficit has seen an improvement after signing the free trade agreement with smaller economies. But when it looks at the FTA with the larger economies such as say Japan, Singapore, Malaysia, etc., our imports are more than our exports. So current account deficit has worsened. So here the statement is cancelling all the free trade agreements. Is it the solution? This is not the solution. Rather, if the statement was renegotiating the FTAs, if the statement was renegotiate the FTAs, then probably the statement was correct. So the right answer would be 1 and 2 only. Look at practice question number 3. Let me know the answer. India receives the world's highest remittances, both in terms of absolute value and percentage of GDP. So here, as you can see, both the statements are wrong. India receives the world's highest remittances only in terms of absolute value, not in terms of percentage of GDP. And India receives the highest remittances from the Gulf countries. Let me know the answer for the next practice question. This one. Which among the following can possibly lead to increase in the capital account surplus in the balance of payment account? What do you think is the answer? First one is increase in the sectoral caps on foreign investment, adoption of Fed tapering in USA, increase in the bond yields in USA. What do you think is the answer? So here you are required to link two things. One, you are required to understand as to how the US Fed Bank policies impact India. And then you are required to link as to how the capital account in case of India will change according to that. That is how questions are asked in UPSC Prelims examination. I hope you are getting this point. So just understanding the economic survey in terms of what is balance of trade, what is balance of invisibles, all of these things will not help you. Understanding the economic survey, particularly from the perspective of the prelims examination, particularly in terms of the nature of questions, that is how you gain a mastery over economy. So if you look at this one, increasing the sectoral caps on foreign investment, yes, that is obviously will lead to capital account surplus. Second one is adoption of Fed tapering in US. Some of you, if you're not aware of Fed tapering, don't worry. That's part of the discussion in this particular class itself. But what you are required to understand right now is whenever the US Fed Bank adopts Fed tapering, this leads to huge outflow of dollars from the Indian economy. So current account, capital account, will not become surplus. Rather, the capital account surplus will come down. So the statement here is wrong. Third one is increase the bond yields in USA. If bond yields in USA are increasing, the investors who have invested money in India, they will withdraw that money and start investing in US bonds. So this once again will lead to outflow of dollars. So the right answer here should be A. That is one only. I hope you're getting this point. So one should be prepared to handle such kind of questions which require cross linkages between what is happening in the global economy with what would happen to the current account and capital account. Are we clear on this? Okay. Okay, next is very interesting topic. Please focus here. The next topic is about net international investment position, NIIP. See, every year the economic survey keeps on highlighting as to what is present status of India's net international investment position. So far, UPSC has not asked question related to what is NIIP. Since this is a topic which UPSC has not asked a question on, this becomes a potential question for your upcoming prelims examination. So from the perspective of the examination, you must understand as to what exactly is net international investment position and how this NIIP is different from the balance of payment. Now, before discussing the concept of NIIP, let me first take you back and make you understand the concept of the fiscal deficit and debt of India. Difference between fiscal deficit and debt. See, when you look at fiscal deficit, what does a fiscal deficit represent? Fiscal deficit represents how much money the government has borrowed in a single year, right? So can I say the fiscal deficit in a way represents annual flow of how much money the government is borrowing? When you look at the debt, what is a debt? Debt is not a flow. Debt is a stock of total outstanding loans of the government. So basic difference between fiscal deficit and debt is fiscal deficit is a flow, annual flow, whereas debt is a total stock of the outstanding loans of the government. Extend the same logic to balance of payment and the net international investment position, NIIP. Remember what I said about balance of payment? Balance of payment is a record of the economic transactions for a period of 1 year. So can I say it's an annual flow? Annual flow of how much money is coming in and going out of the country. Now, under this balance of payment, you have capital account, right? Under capital account, you have FDI and FPI, foreign direct investment and foreign portfolio investment. Now, what happens under this capital account is a Indian company, a company based in India, it is making investment in FDI or FPI in other countries, right? So when an Indian company is making investment in other countries, either in terms of FDI or FPI, can I say that these will become external assets for the Indian economy? They'll become external assets when we are making investment in other countries. They become our external assets. Similarly, a foreign company is coming into India and it is investing in the form of FDI and FPI. Now, what do they become for us? Can I say that they will become our external liabilities? Are you getting this point? So when we make investment in other countries, they become our assets. When foreigners make investment in India, they become our liabilities. So what is the total stock? The total stock of our external assets and external liabilities, that is calculated through the net international investment position. BOP will only tell us how much money is coming in and how much money is going out. But because of this inflow and outflow, we may have accumulated assets in other countries. Foreign residents may have accumulated assets in India. So what is my total stock of assets and liabilities? That is denoted through the net international investment position, NIIP. To make your understanding more simpler, you can have a look at this particular figure here. So please concentrate here. You have Indian residents. Indian residents are investing in other countries in form of FDI, FPI, and we may also deposit money in other countries. So all of these will become external assets for the Indian economy. Similarly, foreign residents, they may make investment in terms of FDI, FPI, or they may make deposits in the Indian economy, and they become our external liabilities. So when you look at NIIP, NIIP tells us the total stock of our external financial assets and liabilities. And how do you calculate this? This is calculated as total external assets for the Indian economy minus total external liabilities of the Indian economy. How much assets we Indians own in other countries minus how much assets the foreign residents own in the Indian economy. That is how the net international investment position is calculated. So here there are two possibilities. One is if the NIIP is positive. If it is positive, what does this mean? It means that the assets that we own in other countries, that is more than the assets that non-residents own in India. So that means that India is a net creditor country. On the other hand, if we own less assets in other countries and if foreign residents own more assets in India, then the value of NIIP would be negative and India would be a net debtor country. Are we clear on this? So BOP is a flow, whereas NIIP is a stock of our total external assets and total external liabilities. So what do you think India's NIIP could be? Is it positive or is it negative? What do you think about it? Do we own more assets in other countries in comparison to the assets owned by foreign residents in India? What do you think about it? So now, if you see about NIIP, I hope you are able to see this trend, right? So right now, India's NIIP is around minus $332 billion. Minus, it is negative. So when I say negative, what does this mean? It means that we as Indians own less assets in other countries in comparison to the assets owned by foreign residents in India. So the NIIP for India, it is minus 332, which when expressed in terms of percentage of GDP, it is minus 11.3. But one important thing here is, as you can see in the last 4 to 5 years, NIIP has seen a decline. Please remember this. Two things you have to remember. NIIP for India is negative, which means that India is a net debtor country. Second, NIIP has seen a decline in the last 4 to 5 years. That is more than sufficient. Clear? Now look at this practice question. Let me know the answer. With reference to net international investment position, which of the following statements are correct? What do you think is the answer? Parthasarthi, I'll come to a doubt at the end of the class. Don't worry. Okay. You can lower your hand. Okay. As you can see here, the first statement is wrong because it says that it's an annual flow. It's not a flow, it is a stock. A positive NIIP highlights that a country is a creditor country. Yes. So the right answer is 2 only. Now look at this question and tell me the answer. What do you think is the answer to this? Which among the following can possibly lead to improvement in India's NIIP? What factors can lead to India's improvement in India's NIIP? Now, if India's NIIP has to improve, what should happen? Our assets should increase and our liabilities should reduce, right? I hope you are with me on this. My total external assets should increase and my liabilities should reduce. Look at the first one. Higher FDI inflows into India. When more of FDI is coming into India, what is happening to my liabilities? My external liabilities is increasing, right? So this option is ruled out. Second one is decrease in external commercial borrowings. So when we borrow less amount of money from other countries, can I say my external liabilities is reducing, right? So this option is correct. Increase in non-resident deposits in India. When more number of people are depositing money in India, my external liabilities will increase. Yes. So the right answer in this particular case should be 2 only. So that is how we can expect a question as far as NIIP is concerned. So with respect to NIIP, understand the concept of NIIP, the trends with respect to NIIP, and what factors can lead to a improvement or deterioration as far as NIIP is concerned. If you remember these things, that's more than sufficient. Now coming to India's present status of external trade. As to what is the present status of India's external trade? So as you can see in Prelims 2020, we had this question about what is the present status of India's external trade. So broadly, you must understand as to what is the status of India's external trade from the perspective of the prelims examination. So let's look at the present status. So as far as the merchandise exports is concerned, so as you can see, the top 3 exports from India are petroleum products, pearls and precious stones, and iron and steel. See, when it comes to petroleum products, I hope you must be knowing that almost 80% of the oil that we use in India, we import it from other countries. So basically, we import crude oil from Gulf countries. The crude oil so imported is in turn refined into petrol, diesel, and other petroleum products. And these petroleum products are in turn exported to other countries, such as say Nepal, Sri Lanka, Singapore, Malaysia, UAE, and so on. So India as such has a unique geostrategic location. It is located between the oil exporting countries and the East Asian countries, which are majorly oil importing. So that is why India has developed huge refining capacity. So that is the first one. Second one is India is also considered to be one of the largest importer of gold. So every year we import more than 1,000 tons of gold. The total value, import value of gold is as high as around $55 billion. So what we do is we obviously import gold for our domestic consumption. Apart from that, the gold that is so imported, it is processed or converted into jewelry and then exported to other countries. Apart from that, we also import rough diamonds, rough precious stones. The rough diamonds and rough precious stones are in turn polished. And once they are polished, they are exported back to other countries. For example, you must have heard of a place called Surat in Gujarat. It is being said that almost 90% of the polished diamonds sold across the world, they're actually polished in Surat. So Surat is considered to be one of the largest diamond polishing center in the entire world. So what we do, we polish the diamonds, we polish the precious stones, and then we export it back. And if you look at the top export destinations for India, the top export destinations are USA, UAE, and China. Merchandise imports into India, crude oil, gold, and petroleum products. Top import sources are China, UAE, USA. Please remember these important facts. Next, if you look at India's merchandise trade deficit, so please focus on the last column. This column tells you with which all countries India is having trade deficit or trade surplus. So as you can see, India is having trade surplus with countries such as USA, Bangladesh, Nepal, Turkey, Netherlands, UK, Italy. Whereas with all other countries, we are having a deficit. And among the countries which we have a trade deficit, the highest trade deficit we have with which country? China. So if at all you come across a question in the UPSC prelims as to with which among the countries does India enjoy trade surplus, or with which among the countries does India has a trade deficit? So accordingly, you have these things. Top import source countries. So top import source countries are China, UAE, and USA. These are top import source countries. Okay, now coming to the concept of FDI, foreign direct investment. Once again, one of the most favorite question of UPSC, because repeatedly UPSC has been asking question with respect to various aspects of foreign direct investment. In particular, UPSC has been asking questions on those aspects of FDI which normally students neglect. On those things, UPSC has been asking questions. For example, as you can see in prelims 2021, we had asked UPSC had asked this question as to which of these instruments are considered as FDI into India. Normally, when students study for UPSC prelims examination, they don't study all of these aspects. Similarly, we had this question in prelims 2020 about which among the following is a major characteristic of FDI. So every year, UPSC is asking some question related to FDI, which normally we don't study. So if you have to prepare for this particular topic of FDI, you need to go through the FDI consolidated circular. So if you type this thing in the Google, you'll get to know, you can have a download this copy, FDI consolidated circular. So in this particular circular, everything about FDI is covered. As far as you are concerned, you need not worry, because as part of the prelims revision classes, I shall be discussing all of these aspects in the revision classes about the FDI consolidated circular. Okay. So let's briefly understand some aspects about foreign direct investment. So you know that foreign money, foreign inflows come into India either to FDI or FPI. This particular categorization of FDI and FPI is in turn based upon the recommendations of Arvind Mayaram Committee. So based upon the recommendations of Arvind Mayaram Committee, we have defined as to what is FDI and what is FPI. So what exactly is FDI then? See, FDI is when a foreign company makes an investment of 10% or more in a listed company, listed Indian company. When I say listed Indian company, means this company is listed on the stock exchanges. So if it makes an investment of 10% or more, then it will be considered as FDI. And if it makes investment in an unlisted company, that is a company which is not listed on the stock exchange, irrespective of how much investment it is making. I repeat, irrespective of how much investment it is making in the unlisted company, it will always be treated as foreign direct investment. So in a listed company, if it is making investment of 10% or more, we call it as FDI. If it is making an investment of less than 10%, then we call it as FPI, foreign portfolio investment. This difference is based upon the recommendations of Arvind Mayaram Committee. How does FDI come into India? I hope you know the things. FDI can come into India either through the approval route, that is the government route, or the automatic route. Under automatic route, there is no need for prior approval. But when it comes to the government route, under the government route, the approval has to be taken from the concerned ministry or a department. For example, if a foreign company wants to make investment in coal mining, the permission or approval will come from Ministry of Coal. If it wants to make investment in telecommunication, approval will come from Ministry of Telecommunication. So concerned ministry or a department will give the approval. But one thing you must understand here, that if a particular foreign company is making an investment of more than 5,000 crores, please remember this. If a foreign company is making an investment of more than 500 crores, then the approval should come from Cabinet Committee on Economic Affairs. Anything below 5,000 crores, approval will be given by the concerned ministry. But if the proposal is for an amount greater than 5,000 crores, approval will come from the Cabinet Committee on Economic Affairs. Clear? Okay. Apart from that, what all things you need to understand as far as the FDI is concerned, that is from the perspective of prelims. I have incorporated these things here. So here, please focus on the third row. Third row tells us as to what are the eligible instruments for FDI. This was a question which was asked in, this prelims 2021. So let's understand this. What are the eligible instruments? First eligible instrument is obviously the shares. So if a foreign company is buying more than 10% shares, 10% or more shares of an Indian company, then it will be called as FDI. Second one is convertible debentures. What do you mean by convertible debentures? Let's understand that. I hope most of you know the concept of bonds, right? So a company issues a bonds in order to raise money or borrow money from the market. Debentures are similar to bonds. That is, a company will issue debentures in order to raise money from the capital market or to borrow money from the market. But there are some important differences between bonds and debentures. Let's understand these differences. First difference is bond. It is considered to be a secured debt. Secured debt means bond is backed by a collateral. Whereas debenture, it is unsecured debt, which means there's no collateral to back debenture. So bond is secured debt, whereas debenture is unsecured debt. So tell me, between these two, which is more riskier, bond or debenture? Debenture is more riskier in comparison to bond. Since debenture is more riskier, can I say rate of interest on debenture will normally be more than the rate of interest on bonds? Are you with me on this? So bond and debenture, if you see the difference, bond is secured, whereas debenture is non-secured debt. Since debenture is non-secured, it is more riskier. Since it is more riskier, it will have a high rate of interest. But one important difference between bond and debenture is, see, once the bond matures, say if it has a maturity period of 5 years or 10 years, once the bond matures, the company which has issued the bond, it will be required to repay the money back to the investors. But in case of debentures, you have a specific type of debentures called as convertible debentures. Convertible debentures, what happens is, you can convert the principal amount into the shares of a company. So let's say you have bought a debenture whose face value is equal to rupees 100. So you can convert this rupees 100 into the shares of the particular company. So we call them as what? Convertible debentures. Now, can I say that if a foreign company is buying convertible debentures issued by an Indian company, this foreign company will gain an ownership in the Indian company, right? And if it gains more than 10% ownership, don't you think it will be called as FDI? Are you with me on this? So the convertible debentures are also part of FDI. Next one is very important. Foreign currency convertible bonds. Please focus here. Foreign currency convertible bonds. Now let's say there's an Indian company. This Indian company can issue bonds in India. That is in the Indian domestic market. when it is issuing bonds in the Indian domestic market, the bonds will be denominated in terms of rupees. That is, face value will be in terms of rupees. But the same Indian company, it can issue a bond in foreign country, let's say in US. And when it is issuing a bond in US, this bond will be denominated in terms of dollars, which means we are not raising money in terms of rupees. We are raising money in terms of what? Dollars. Principal is in terms of dollar. The interest payment is also in terms of dollar. What we call them as? We call them as foreign currency bonds. Foreign currency bond principal as well as interest, both are in terms of foreign currency. Apart from that, some of these foreign currencies are also foreign currency bonds. They are also considered to be convertible, just like debentures. So even this foreign currency bonds, some of which are convertible, it means that if a foreign investor has bought this foreign currency convertible bond, it means that the principal amount may get changed into the shares of a company, just like debentures. Are we clear now? Last and most important is depository receipts. So what are these depository receipts? Now let's say there's a company. Let's consider the case of Paytm. Now Paytm can issue shares in the Indian domestic market, right? Apart from issuing shares in the Indian domestic market, this Paytm company can also issue shares in, say, US or say in other countries. So by issuing shares in USA or in other countries, if this company is raising share capital, the instrument through which this Indian company is raising share capital from other countries, we call them as what? Depository receipts. So depository receipts are the instruments through which the companies, Indian companies, raise share capital from other countries. For example, with respect to depository receipts, you have ADR, which stands for American Depository Receipts. So if an Indian company wants to raise share capital, that is, if it wants to issue shares and raise capital in US market, the route through which it raises money, we call it as American Depository Receipts. And we have other type, that is GDR, which stands for Global Depository Receipts. Global Depository Receipts are the generic name which the Indian company can use to raise share capital anywhere across the globe. So ADR is something which is specific only to US. GDR can be issued anywhere across the world. So that's the basic difference. So these are the different instruments to which foreign direct investment can be raised by the Indian company. So same question was asked in Prelims 2021 as well. Are we clear? Now, if you see the important pointers for the Prelims examination, I have incorporated all the important things from the perspective of your Prelims examination. So here, there's a report called as World Investment Report. The World Investment Report is published by UNCTAD. So if you look at the latest report, that is World Investment Report published by this international organization, the country which receives the world's highest FDI is USA, followed by China, followed by Hong Kong, Singapore. And as you can see, India is presently placed at which position? 5th position. Last year, India was placed at 9th position. So India's has attracted more FDI inflows, and that is why India's position has improved from 9th to 5th position. Second, if you see, this is very important from the perspective of the prelims examination, important trend. India has received its highest ever FDI inflows of $80 billion in the year 2021. Highest ever FDI inflows so far in the year 2020-21. And please remember this important facts which could be asked in the prelims examination. Apart from that, in this particular table, I have incorporated the important changes in the FDI policy in the last 1 to 1.5 years. I'm pretty sure that you can go through these particular table and understand as to what all changes have been incorporated in the FDI policy. Now coming to India's forex reserves. Once again, one of the most favorite topic of UPSC. Repeatedly questions have been asked with respect to various aspects of India's forex reserves. For example, in prelims 2013, we had this question as to which all items are included in India's foreign exchange reserves. Prelims 2020, we had this question related to the reserve transposition. And in prelims 2016, we had this question related to what do you mean by import cover when it comes to forex reserves. So let's understand various aspects of India's forex reserves. So as you can see, with respect to India's forex reserves, we have basically 4 components which are part of forex reserves. One is, first one, foreign exchange assets. See, when we say foreign exchange assets, normally we keep on thinking that it is just currencies, that is dollar, euro, pound, yen, and so on. But please understand that it is not just the currency. Apart from currency, it also includes the investment in foreign government securities. It includes the deposits with the other central banks. It includes the deposits with the overseas branches of commercial banks. So all of these are together referred to as foreign exchange assets. So if you get a question in the prelims examination, which among the following are the components of foreign exchange assets, part of balance of payment, part of forex reserves. So please understand it includes currency, investment in foreign government securities, deposit with other central banks, and deposit with the overseas branches of the commercial banks. Next is monetary gold. So what is this monetary gold? See, when you look at the gold in India, this gold can be broadly categorized as monetary gold and non-monetary gold broadly. Monetary gold is a gold which is part of India's forex reserves. Monetary gold is a gold which is part of India's forex reserves. Everything else, which means the gold which is not part of India's forex reserves, it will become the non-monetary gold. Please remember this from the perspective of the prelims examination. The gold which is part of India's forex reserves is called as monetary gold. Everything else, that is gold with the public, gold with the banks and financial institutions, gold which is in circulation, all of that will be called as non-monetary gold. Next is Sdr and reserve position in IMF. So let's understand briefly about Sdr and reserve position in the IMF as to what are these things. You can see here, what is the role of IMF? The role of the IMF is to give loans to the countries which are facing BOP crisis. Now question is, if IMF is giving loans, from where is IMF getting the money to give loans? To get money to give loans, IMF will ask all the member countries to make the contribution. So any country which wants to become a member of IMF, it is required to make a contribution. How much money our member country contributes to IMF, we call this as quota. And this quota in turn depends upon the size of the economy, the openness of the economy, and the total of forex reserves a country has. Based upon some parameters, the quota is fixed. For example, if you look at USA has a quota of 17%. What this means is, out of the total money mobilized by IMF from its member countries, US has contributed how much? 17%. So let's say, for example, let's say IMF has mobilized $100 billion from the member countries, out of which US would have contributed how much? $17 billion. I hope you're getting this point. As far as India is concerned, India's quota is 2.76%. So let's say if the total money mobilized by IMF is $100 billion, India would have contributed $2.76 billion. Are you getting this point? And this quota as such, this quota, for example, this quota, it has to be paid in domestic currency and the foreign currency. And please remember here, 75% is in domestic currency. Remaining 25% of our quota, it can be paid in foreign currency, such as dollar, euro, pound, yen, yuan, and so on. More importantly, this 25% of our quota, this need not be kept with the IMF. India can keep this quota, that is 25% of the quota, with itself as part of our forex reserves. That is why we call it as what? Reserve transposition. Are you getting this point? So this component of 25% foreign currency we will not keep with the IMF, rather we can keep with ourselves as part of forex reserves, and we call it as RTP. It is almost similar to SLR. You know SLR, right? Statutory liquidity ratio. So banks are required to keep certain percentage of depositors' money with themselves. So it is something similar to that, RTP. And once the quota is fixed, quota will in turn determine the voting rights, access to loans, and how much special drawing rights do you get. For example, India's voting rights is almost like 2.6%. And based upon our quota, we get special drawing rights. Special drawing rights, I've already explained it before as well. So briefly to touch upon the SDR. SDR is not a currency. Rather, it is an international reserve asset, which is part of our forex reserves. SDR is basically a basket of 5 currencies. That is dollar, euro, pound, yen, and yuan. So we get SDR in proportion to our quota as such. And this SDR can be used for multiple purposes. For example, it can be used to repay the loans that we have taken from the IMF. These SDRs, they are considered to be a claim on the currency, which means the SDR can be easily converted into dollar, euro, pound, yen, and yuan. That is why we call them as claim on the currency. They're not currencies as such. Now, why this becomes important is recently the IMF has decided to increase the total SDR allocation by $450 billion. Most of the countries, they have got affected because of COVID-19 pandemic, and some of the poor countries, they are not in a position to import certain essential goods, that is pharmaceutical drugs. So that is why IMF has recently decided to increase its SDR by $450 billion. And if you look at India's quota, how much it is? 2.76%. So 2.76% of $450 billion, if you see, it will be approximately equal to $11 billion. So this is the amount of SDR which India has got as recently from the IMF. Clear? So if you see here, so these are the 4 components. And please understand here, our foreign exchange reserves are always denominated and expressed in terms of dollars. Please remember this. And if you look at the countries, the highest forex reserves, look at India's position. India is presently placed at 4th position. India has the world's 4th largest forex reserves. And as on April 2021, we had almost $520 billion. And look at the different shares of the components. Highest component is foreign exchange assets, followed by gold, reserve position, and SDR. For example, if you get a question as to which among the following components account for the highest share in India's forex reserves, the answer would be foreign currency assets. And then if you want to know adequacy of reserves, you have different concepts. One is import cover. Import cover basically means that by using our forex reserves, how many months can you pay for the imports? Using the forex reserves, how many months you can pay for the imports? That gives us the import cover. For example, let's say in 1 month, we import goods worth $100 billion. And let's say our forex reserves is $100 billion. So import cover will be 1 month, right? Now, if I want to tell you as to what is exactly India's import cover, annually, our imports are somewhere around $370 billion annually, almost around $370 billion. And of our forex reserves, if you see, our forex reserves are almost like $600 billion. So it's like we have almost like 18 to 19 months of import cover, almost 18 to 19 months of import cover. Then you have another concept of Greenspan Gurati rule. Greenspan Gurati rule basically tells us that we must have adequate amount of forex reserves, which is adequate enough to pay for our short-term external debt. So whatever is a short-term external debt, so that much amount of forex reserves we must always keep. So that is the Greenspan-Gurati rule. So please remember this concept of Greenspan-Gurati rule. Now coming to India's external debt. So this was the question asked in prelims 2019. The question was with respect to what is the present status of India's external debt. So let us quickly go through the present status of India's external debt. See, in the last class we had discussed about the government's finances. There also we had discussed about the debt position of the government. So there we had discussed the debt position of the government purely from the perspective of the central debt. Here, when we are discussing India's external debt, we are including the external borrowings of the central government, the state government, the PSUs, as well as private sector. So what is India's cumulative external debt? Not just limited to the center. That's what we are going to discuss. So as you can see, with respect to India's external debt can be broadly categorized into two types. That is short-term external debt and long-term external debt. If you borrow for less than 1 year, it is short-term. If you borrow for more than 1 year, it is long-term. And the debt, depending upon who is borrowing, can be categorized as sovereign debt and the non-sovereign debt. Becomes quite important because, as you can see, this was a question asked in prelims 2019. So sovereign debt is a debt which is borrowed by the government. Non-sovereign debt is a debt which is borrowed by other than the government, including the private sector. And if you look at the major heads under the external debt, you have multilateral debt, that is the money that we borrow from international institutions such as World Bank, IMF. Bilateral debt, that is a debt which borrow money from other countries. Trade credits. Trade credits basically means that private sector companies, they may borrow loans from banks in other countries to pay for the imports. So let's say there's an Indian company which is importing goods from other countries. To import goods from other countries, it may borrow money in other banks in other countries. That is a trade credit. Next is external commercial borrowings and non-resident deposits. And if you look at the present status of India's external debt, can you see here what is the present status of India's external debt? Total is how much? $590 billion. And what is my forex reserves? Forex reserves is almost same, $590 billion. So can I say, by using my forex reserves, I can pay off my entire external debt? Using my forex reserves, I can pay off my entire external debt, which means that my reserve cover is how much of my external debt? 100%. Are you getting this point? Our reserve cover of external debt is 100%. And remember this, our non-sovereign debt is higher than the sovereign debt. Debt which is borrowed by private sector, that is more than the sovereign debt. And if you look at the components of external debt, this accounts for the highest share. That is external commercial borrowing, and this is followed by non-resident deposits. With respect to duration of debt, long-term debt is higher, almost 87%. Short-term debt is remaining 13%. And with respect to denomination of debt, this is very important. When we denominate the forex reserves is always denominated in terms of dollars, as I said. But when it comes to denomination of our external debt is denominated in different currencies, such as dollar, euro, pound, and so on. So please remember this difference between forex reserves and external debt. Forex reserves always denoted in terms of dollars. External debt is denominated in terms of different currencies. Are we clear? Please explain the trade credits. Now let's say there's an Indian company. This Indian company wants to import goods from other countries. To import goods from other countries, this Indian company may borrow loans from banks based in other countries. That we call it as trade credit. Clear, Monu Vamsi? Okay. Look at the practice question. What do you think is the answer? Answer is B here. Good. What about this? Which among the following accounts for the highest share of external debt in India? External commercial borrowings. Good. Okay, now coming to the most interesting topic of this particular chapter, that is impact of Fed bank policies on the Indian economy. So here we are going to discuss as to what is the impact of Fed bank policies, that is quantitative easing and Fed tapering on the Indian economy. But before discussing this particular topic, why is this topic important as far as your prelims examination is concerned? As you can see in prelims 2021, we had this question as to the yield rates on Indian government bond yields are affected by which among the following? And one option was actions of the United States Federal Reserve, Fed Bank. So what we are going to do here is, we'll first understand the background to this particular story. And then we will understand the impact of US Fed Bank policies on the Indian economy. Clear? So let's discuss the background. I hope you're able to see the screen, all of you. Now, focus on this side first. The year was 2008-9. This was the year when the global economy was affected by the global financial crisis, including the US economy. So because of which the US Fed Bank then adopted the quantitative easing policy. You know about quantitative easing policy? As part of quantitative easing policy, the US Fed Bank will purchase dollars from the US market. By purchasing the bonds from the market, the US Fed Bank pumps in dollars into the US economy. The idea is to stimulate the growth and development. So US Fed Bank had adopted quantitative easing. Slowly, the US economy started recovering. And then somewhere in 2012-13 and 2013-14, the US Fed Bank then announced the Fed tapering. What is this Fed tapering? Fed tapering basically means a slow and gradual reduction in purchase of the government securities. Slow and gradual reduction in the purchase of government securities can be considered as Fed tapering. So let's say earlier, the US Fed Bank was purchasing bonds worth say $100 billion every month. As part of Fed tapering, slowly we will reduce the amount of bond purchases from $100 billion, say we'll bring it down to 80 to 60, 60 to 40. That we call it as Fed tapering. Now, as soon as Fed tapering was announced, the Indian economy got adversely affected because of what is referred to as taper tantrums. What is this taper tantrum? Now, let me explain this taper tantrum through a common day-to-day life example. Now, let's say you're a school-going kid. Let's take you back to your class 6 or class 7th. And let's say you're going to school. And let's say you're getting a pocket money of ₹100 every month. Now, let's say your parents, they have impressed with your good performance, good behavior, and they decide to increase your pocket money from 100 to 200. You'll feel happy. You'll feel elated, right? That your pocket money has got increased from 100 to 200. And then after some months, let's say your parents tell you that slowly and gradually, they will start reducing your pocket money from 200 back to 100. Are you getting this point? Slowly and gradually, they'll say that your pocket money will be brought down from 200 to 100. What will you do as a kid? Will you not start throwing tantrums? You'll start throwing tantrums that will not go to school. You'll not study. Most of us have already done that during our school days, right? So here, the investors are also like school kids. So far, because of quantitative easing, they used to get easy liquidity. As part of quantitative easing, they used to get easy liquidity, just like how as a kid, your pocket money got increased from 100 to 200. So the investors very happy because they're getting easy surplus of money. Now we have announced that in future, we will reduce the purchase of the government securities. And in future, if you are reducing the government securities, purchase of government securities, can I say in future, the rate of interest will increase? rate of interest is not increased now, but in future, the rate of interest is going to increase. In anticipation of what is going to happen in future, the investors will start throwing tantrums. Just like you as a school kid, when you are informed that after 2 to 3 months, your pocket money will get reduced. Pocket money has not got immediately reduced, but it will start getting reduced after 2 to 3 months. You'll start throwing tantrums. So just like that, in anticipation of what is going to happen in future, or in anticipation of future increase in rate of interest in US market, the investors will start throwing tantrums. This we call it as taper tantrums. How does it affect India? It will lead to higher dollar outflows, rupee depreciation, costly imports, higher inflation, higher current account deficit, decrease in forex reserves. Don't worry about this particular impact. I will be discussing as to how the Fed tapering will affect India in the next slide. Don't worry about this. I'm just giving you the background. So last time when Fed tapering was announced, we had seen this effect of taper tantrums on the Indian economy. Now, come back to the present stage. 2019-20, we face economic slowdown. Same as the global financial crisis. Story is repeating, right? Story is repeating here. So now there's a global economic slowdown. US Fed Bank had adopted quantitative easing similar to what it had done before. In 2013-14, it had announced Fed tapering. Now in November 2021, it has announced Fed tapering. So question is, will India see a repeat of what it had faced before? Will India see the same repeat now? And if at all this taper tantrum takes place, do we as an economy have the resilience to withstand this external shocks? That is what this economic survey is discussing about. Are you getting this point? So first thing it discusses as to whether are we going to see the taper tantrum, and if taper tantrum takes place, do we have the capacity to withstand the external shocks? Can we withstand all of these things taking place? As far as prelims examination is concerned, what you must understand is what is quantitative easing, what is Fed tapering, how it is going to impact Indian economy, and what is taper tantrum. Are we clear? So let's convert it into UPSC centric knowledge and just discuss it purely from the perspective of UPSC prelims examination. So what I have done here is this slide I have incorporated as to how the US Fed Bank policies has an impact on Indian economy, both on our bond market as well as on our entire Indian economy. So let's understand this, starting with the quantitative easing. Please focus on this side. Now let's say the US Fed Bank has adopted quantitative easing. Now, as part of quantitative easing, the US Fed Bank as such, since June 2019, it was purchasing bonds worth almost $120 billion every month. So can you imagine the amount of bond purchases? How much it is? $120 billion worth bonds, US Treasury securities, mortgage-backed securities. They were purchased by US Fed Bank. So every month, US Fed Bank was injecting dollars worth $120 billion, because of which the rate of interest in the US economy started reducing. Now let's say you are an investor based in USA. You are a US-based investor. One thing is you're getting a lot of dollar money. You're getting a lot of dollar. Second, you're getting dollar at a very cheap rate of interest. So what will you do? You'll probably want to invest your dollar in the countries which have high growth potential. So which country has the highest growth potential? We have the highest growth potential. So you as an investor based in USA, you are getting dollar easily. That dollar you'll start making investment in India, right? So you'll start and you'll come to India and start making investment in India. And let's say you start making investment in government securities. So can I say when more number of foreign investors are coming into India and they are buying government securities, demand for government securities will increase. As the demand increases, the bond prices will increase. As the bond prices increase, we know bond price and bond yields, they are inversely proportional. Bond yields will come down. Did you get this point? Let's understand the medium-term impact on the Indian economy. First thing is, we are getting more foreign inflows because of the rate of interest, reduced rate of interest in US. More foreign inflows means our forex reserves will increase. So we are already seeing now India has the world's 4th largest forex reserves. Rupee value will appreciate, right? For example, say from $1 is equal to 60. Now $1 will become equal to 50. So rupee value will appreciate. What does this mean? Now let's say I'm importing this marker worth $1 from US. Earlier, how much was I paying? I was paying 60 rupees. Now how much money will I pay? 50 rupees. So can I say my imports have become cheaper? Right? If my imports have become cheaper, can I say my rate of inflation in the economy will also reduce? Why? We know India is majorly a import dependent country, wherein we are majorly importing oil, crude oil. So if the cost of importing crude oil reduces, the inflation in the Indian economy will also reduce, because oil as such is a critical input for the economy. Oil is used for transportation, oil is used for manufacturing, oil is used for so many purposes. So if you're importing oil at less prices, inflation will come down or not. So if you look at quantitative easing, these are the effects on the Indian economy. Now what has happened is the US Fed Bank has announced that it will adopt Fed tapering. See, so far, every month, US Fed Bank was injecting dollars worth $120 billion every month. Suddenly, if you stop the injection of dollars, don't you think there will be liquidity shocks in US economy? So suddenly we cannot stop the purchase of the bonds. So what we do is slowly and gradually we start reducing the purchase of bonds. Say from $120 billion, we'll bring it down to 100, 100 to 80, 80 to 60. That we call it as Fed tapering. So because of this Fed tapering, what will happen is in future, the rate of interest in the US economy will increase, not immediately, in future. So please remember this. And if rate of interest in the US economy is increasing, how it is going to impact the bond market? Let's understand. So here we are going to discuss the impact of bond market in USA, not on India. Earlier, US Fed Bank was purchasing bonds worth $120 billion every month. Now it has started reducing the purchase of bonds. So can I say now the demand for bonds in the US market will reduce, right? So since the demand for bonds will reduce, bond prices will reduce, and bond prices and bond yields are inversely proportional. Bond yields will start increasing. Are you getting this point? Now let's say you are a US investor. You have invested your money in Indian bonds, Indian government securities. US Fed Bank has announced Fed tapering. Because of announcement of Fed tapering, there's an anticipation that in future, demand for government securities in US will increase. Because of demand for government securities in US will reduce. Because of that, the yield rates in US will increase. So what will you do as a US investor? You'll sell off your investments that you have made in India. You'll take out your dollar. You'll start making investment in US, right? So what will you do is you'll start selling off the government securities in which you have made investment. So as far as India is concerned, because there's a rising yields in US, investors will start selling off the government securities in India. And as they start selling off the government securities, supply of government securities will increase. Supply will increase. As the supply increases, the prices will drop. As the prices drop, the yield rates on the Indian government securities will start increasing. Are you getting this point? Next, what happens is more amount of dollar will start going out of country. More dollar outflows means, can I say rupee value will get depreciated, right? Now, when rupee value will get depreciated, let's say $1 equal to 60. Now $1 becomes equal to ₹70. Apply the same logic. To import this marker worth $1, earlier I was paying 60 rupees. Now how much money will I pay? 70 rupees. So can I say when rupee value undergoes depreciation, my imports have become costly? when imports of petroleum products increases, prices of petroleum products increases, rate of inflation will increase or not? So rate of inflation will increase. Similarly, when my imports become costly, can I say my current account deficit will increase? Yes or no? Current account deficit will increase because my imports have become costly. India is majorly importing country. There will be a decline in India's forex reserves. And last and most important is, as the yield rates on the government securities increases, the borrowing cost of the government will increase. As to how the borrowing cost of the government increases, I will be discussing in the next chapter, that is banking and finance. So right now you understand that if the yield rates on the existing government securities in India is increasing, the borrowing cost of the government will increase. So this is an adverse impact as far as Fed tapering is concerned. In what way UPSC could ask you questions? I'm going to show you the questions. But I hope this part is understood, right? So whatever you need to understand about quantitative easing, Fed tapering, and its impact on the bond market in India, bond market in USA, impact on Indian economy, I have discussed. So when you say taper tantrum is effect of the US investors or investors, global investors, responding to the Fed tapering. They are basically responding to what is going to happen in future. This has not really happened. Has the rate of interest in US increased? It has not increased, but it is going to increase in future. So in anticipation of what is going to happen in future, the US investors have already started taking actions. Similar to the example which I gave, I was a school kid. Your parents have not reduced the pocket money. They simply said that they'll reduce the pocket money. So in anticipation of what is going to happen in future, you'll start throwing tantrums, right? Similar to that concept. So let's look at the questions from this. Look at practice question, this one. What do you think is the answer? Quickly. Which among the following best describes the concept of taper tantrum often seen in news? I'm waiting for everyone to answer. Please answer. All of you. Unless you don't answer, how will I know that whether you understood the concept or not? So look at the options here. It refers to adverse impact on the developing economies due to sale of government securities by US Fed Bank. Is it sale? No. Option C, it refers to large-scale foreign outflows from the developing countries due to decrease in rate of interest in US. No. It refers to large-scale massive foreign inflows into developing countries. No. So the right answer is B. It refers to the adverse impact on the developing economies due to the announcement of reduction in the purchases of the securities by the US Fed Bank. Look at the next practice question. What do you think is the answer? Taper tantrums in the developing countries such as India is associated with which among the following? Sudden appreciation in Indian rupee? No. The rupee value will depreciate. Decrease in bond yields? Will the bond yields decrease? No. Bond yields will increase. Volatility in capital market? Yes. Because large inflows and outflows. So the right answer here should be C. Are you getting this point? So that is how UPSC would ask you questions related to the impact of US Fed Bank policies on the Indian economy. So these are the questions as far as taper tantrum is concerned. Similarly, you can get questions related to the Fed tapering and its impact on the Indian economy. So whatever things you need to understand as far as Fed tapering is concerned, it is there in front of your screen. I guess that is more than sufficient. Okay. And apart from this, economic survey has not discussed much. What economic survey has basically done is it has said that we need not be worried that the taper tantrums will have an effect on Indian economy. It has basically highlighted that Indian economy is more resilient this time. For example, it has said last year, that is when last time when this taper tantrum took place, our CPI rate of inflation was 9.4%, but this time it is lower at 5.2%. So all of these things, but not really important from the perspective of the prelims examination. So whatever things you need to understand from the perspective of prelims, I have discussed that. Are we clear on this? Okay. Now coming to the next topic, next chapter, that is banking and finance. Another interesting chapter, that is banking and finance. See, as far as this particular chapter is concerned, if you correlate with your UPSC prelims examination, we have seen that in UPSC prelims, maximum weightage has been given to chapters or themes, that is banking and finance, inflation, taxation, and external sector. So these are the 4 themes which have been getting the maximum weightage. So we have already discussed the external sector, we have discussed the taxation. So we are going to discuss the banking and finance. So this is the first chapter in banking and finance. The next chapter which I'm going to discuss is the inflation. Both these 2 chapters, they are the most interesting chapters as far as the economic survey is concerned. So in this particular chapter, we'll look at the monetary policy developments, concepts related to reserve money, broad money, and money multiplier. So here, I'm going to discuss as to how changes in the cash reserve ratio, that is CRR, would have an impact on reserve money, broad money, and money multiplier. Why this becomes important? Because repeatedly you have seen that questions have been asked with respect to various aspects of money supply in the economy. That is why this aspect become important. Then various steps taken by the RBI to improve liquidity, performance of banks, and the other topics. So let's start off with the monetary policy development. We'll come back to this question later. So as far as the monetary policy development is concerned, not much to discuss here. What you must understand is, because of the economic slowdown, the Reserve Bank of India has reduced the repo rate to 4%. And right now, the repo rate is at its lowest level in the last 10 years. So as you can see, in the last 10 years, that is from April 2001 to April 2021, the repo rate is at its lowest level. And since February 2019, the repo rate has got reduced by 250 basis points. Not important from the perspective of prelims examination. What here you just have to understand that RBI has reduced both repo as well as reverse repo in order to support economic growth and development. Now this is where things get interesting. Can you see this thing? Okay, please focus on this part. See, you know that whenever there's an economic slowdown, what does the RBI do to the policy rates? Policy rates are reduced. Policy rates such as, say, SLR, CRR, repo, reverse repo, and so on, all of these policy rates are reduced. So initially, in March 2020, the Reserve Bank of India reduced the cash reserve ratio from 4% to 3%. You know cash reserve ratio, right? Cash reserve ratio is the percentage of the depositors' money which the banks are required to maintain with the Reserve Bank of India in the form of cash. So RBI reduced the cash reserve ratio from 4% to 3%. Later, in March 2021, we brought back the CRR from 4% to 3% to 3.5%. And then in May 2021, we further increased the CRR from 3.5 to 4%. So initially what we did, we reduced the CRR from 4 to 3%. And now from 3%, we have brought it back to 4%. Now, as far as economic survey is concerned, economic survey has discussed as to how these changes in the cash reserve ratio has impacted the reserve money and the broad money. So that is what we are going to discuss here. So let's understand those things. Now, I'm pretty sure that most of you must have studied about aggregates of money supply, right? You must have studied about aggregates of money supply such as M0, M1, M2, M3, and so on, right? Now, if you look at M0, it is referred to as the reserve money, and M3 it is referred to as the broad money. So here what we are going to discuss is how changes in CRR would have an impact on M0, M3, and how it is going to have an impact on the money multiplier in the economy, MM. Clear? So let's understand these things, starting with reserve money. Reserve money, it is also referred to as high-powered money. High-powered money. So what exactly is the reserve money? See, if you have to arrange these things, M0, M1, M2, M3, in the descending order of liquidity, which of these is considered to be most liquid? M0 is considered to be most liquid, right? It is considered to be most liquid. And M0, it becomes important because M0 is considered to be the direct liabilities of the Reserve Bank of India. It's a direct liability. So it's a total liabilities of the RBI. So how do you calculate the reserve money? To calculate reserve money, we take into account the total currency with the public, how much money public have with them, currency with the banks, currency with the public plus currency with the banks, we call it as currency in circulation. So please remember this from the perspective of the prelims examination. So when we say currency in circulation, it includes the currency which is with the people plus currency with the banks. It does not include only the currency with the public. So you have the currency in circulation, which is currency with the public, currency with the banks, and then bankers' deposits with the RBI, which is basically the CRR deposits with the RBI. So this is the third component. And look at the fourth component. Fourth component is other deposits with the RBI. Other deposits with the RBI. And this other deposits with the RBI include the reverse repo deposits with the RBI. Now you know this, right? That whenever banks have surplus money with them, the banks can park this surplus money with the RBI and earn interest on that under the reverse repo, right? So have a look at this. When banks keep money with the RBI in the form of CRR, cash reserve ratio, it is part of bankers' deposit with the RBI. But when banks keep surplus funds with the RBI as part of reverse repo, it is part of other deposit with the RBI. Are you getting this point? And then you have deposits made by other domestic and international financial institutions. So totally, this we call it as reserve money. So if I have to tell you the exact value, as on April 2021, this reserve money was approximately around 35 lakh crore. This was my approximate value. 35 lakh crore was my reserve money. So this is the total liability of the RBI. Total liabilities of RBI was how much? 35 lakh crore. Now we are going to understand as to how this changes in CRR is going to affect the reserve money. Can you explain again on reverse repo deposits? So basically what I was saying is whatever money the banks keep with the RBI in form of CRR, cash reserve ratio, it becomes part of bankers' deposit with the RBI. But if banks are parking surplus cash with the RBI in the form of reverse repo, that is not part of bankers' deposit with the RBI. Rather, it is part of other deposits with the RBI. That is what I was saying. Okay. So now let's understand as to how changes in CRR will impact the reserve money. Now let's say the CRR has got reduced from 4% to 3%. Look at this. When CRR has got reduced from 4% to 3%, can I say this part will reduce? Bankers' deposit with the RBI will reduce? Yes. Are you with me on this? Now, assuming, I'm repeating once again, assuming everything else remains constant, which means assuming that currency with the public, currency with the banks, and other deposits with the banks remain constant. And let's say only the CRR has been reduced. What will happen to my reserve money? Increase or decrease? Reserve money will decrease, right? So whenever the CRR is reduced, my reserve money will also come down. Are you with me on this? Next, in March 2021, we increase the CRR from 3 to 3.5%, right? Now, as we increase the CRR, can I say everything else remaining constant, banks now keep more amount of money with the RBI in the form of CRR. So now my reserve money will increase or not? Yes. So can I say here, if the CRR reduces, reserve money will reduce? Yes. If the CRR increases, reserve money will increase, right? So now we have understood as to how changes in CRR will have an impact on reserve money. Now we are going to see how changes in CRR is going to have an impact on the broad money. Clear? Now look at this broad money. So what is broad money? M3. Now M3 basically includes, first one, currency with the public. Second, demand deposits with the banks, that is current account deposits and savings account deposit. Time deposits with the banks, that is fixed deposits and recurring deposits. And same, that is other deposits with the RBA, which is reverse repo deposits with the RBA, deposits made by domestic and other international institutions. So now let's understand as to how changes in CRR would impact my broad money. Now let's say here, my total demand and time liabilities, this is rupees 100. And my CRR was initially 4%. Initially it was 4%. Let's understand this. What does this mean is, out of 100 rupees of the deposits, 4 rupees they used to keep with the RBA. Remaining 96 rupees, they used to be with the bank itself. Got this? Now, this CRR has got reduced from 4% to 3%. Now, what will happen here? 100 rupees. Out of this 100 rupees, 3 rupees will be kept with the RBA. And how much money will be with the bank? Can I say 97 rupees? Are you getting this point? So can I say when the CRR rate is reduced, banks will keep less money with the RBA. Banks will have more amount of money with them. Are you with me on this? So as banks have more amount of money with them, can I say the broad money will increase? Yes. So here, when the CRR has got reduced from 4% to 3%, earlier banks used to have 96 rupees with them, but now banks have 97 rupees with them, 1 rupee more. So the broad money in this particular case will increase. On the other hand, if we reduce the CRR, say from 4% back to 3%, so now they'll have to keep more amount of money with the RBI and less amount of money will be with them. So broad money will reduce. So this is what you must understand. So whenever the CRR rate is reduced, banks will keep less amount of money with the RBI, because of which the reserve money will reduce. Banks will keep more amount of money with them, broad money will increase. So this is what you must understand. I hope we are clear now, all of you. Yes? Okay. Now look at the money multiplier concept. Please focus here. So now with respect to money multiplier, most of you must have already studied that money multiplier, it is calculated as 1 by R, where R stands for the reserve ratio. So here, as you can see, the reserve ratio, it is in the denominator, and the reserve ratio here could be CRR or SLR, either of these two. So as the reserve ratio is reduced, the money multiplier will increase. Whereas if the reserve ratio is increased, money multiplier will reduce. That is what you have already studied. But now, what you must also understand is, if you want to calculate the money multiplier is also calculated as M3 divided by M0. That is broad money divided by the reserve money. For example, if you see, as on April 2021, my broad money was almost like 187 lakh crores. Whereas my reserve money, as I said, it was like 35 lakh crore. So if you try to calculate the money multiplier, I guess it will be more than 5. So this was my money multiplier as on April 2021. So if you want to understand the impact of the CRR on the money multiplier, you can see here, when the CRR rate is reduced, we have discussed that the broad money will increase, reserve money will reduce. So look at this. Reserve money, that is M0, it is in denominator, whereas M3, that is broad money, it is in numerator. So numerator increases and denominator reduces, money multiplier will increase. Similarly here, if there is an increase in CRR, money multiplier will reduce. Now why am I discussing this is, in case if you come across a question with respect to money multiplier from the perspective of broad money and say reserve money. Please remember this, that money multiplier can also be calculated as M3 by M0. Do not think that money multiplier is just always 1 by R. It can also be calculated as M3 by M0. Are we clear on this? Okay. So let's take up a question now. Okay. Look at this question. If a person withdraws 10,000 rupees in the form of cash from his fixed deposit account, which among the following is likely to occur? What do you think is the answer? Let's say you have kept 10,000 rupees in your fixed deposit account. That 10,000 rupees from your fixed deposit account you are withdrawing. So what will happen to the reserve money and the broad money? Anyone? Kapil, I'll come back to your question. Don't worry. I can see varied response actually. Nilesh, good. Nilesh. Okay. Focus here. So did you understand the demand of the question? The question says you have 10,000 rupees in your fixed deposit account and that 10,000 rupees you are withdrawing. Now you are required to find out as to what will happen to the broad money and the reserve money. So let's understand that. Starting with my broad money, please focus here. So here, what the question says is you are withdrawing 10,000 rupees from your fixed deposit account, right? So can I deduct minus 10,000 here? Yes. I'm deducting minus 10,000 here. Now, this money which you are withdrawing from your fixed deposit account, will it not come into your hands as cash? It will come into your hand as a cash, right? So currency with the public will increase by plus 10,000. So here, demand deposits, sorry, the time deposits have come down by 10,000, whereas the currency with the public has increased by 10,000. So what will happen to my broad money? Broad money will remain same. Yes. Now let's understand the reserve money. Look at this. Now focus here. 10,000 rupees you have kept in your fixed deposit account. Is that money which you have kept in your fixed deposit account part of the reserve money? 10,000 rupees which you have kept in your fixed deposit, is it part of the reserve money? Is it getting accounted anywhere here in the other deposits, bankers deposit, currency of the public or currency of the banks? It is not getting accounted. So when you withdraw 10,000 rupees from your fixed deposit account, this money is coming into hands as cash, currency of the public. So here the currency of the public is increasing by 10,000 or not? Are you getting this point? So what will happen to my reserve money? Reserve money will increase by how much? 10,000. Broad money will remain same because the accounting is getting changed. Earlier it was part of fixed deposit, now it will be accounted as currency with the public. But as far as reserve money is concerned, earlier when you had kept 10,000 rupees in the fixed deposit account, that was not accounted here. I hope you are clear now, all of you. Yes. So if you look at the question, question is broad money will remain same while the reserve money would increase. So this is how a question could be asked. So as you can see, repeatedly questions have been asked in the previous year prelims with respect to the money supply. So I just modified that particular question. Okay, now coming to various steps taken by the RBI to manage the liquidity conditions in the economy. banks keep some amount of currency with them for their day-to-day management. So that we call it as the currency with the bank. Steps taken by the RBI to manage liquidity conditions. So you have different steps such as on-tap targeted long-term repo operations, special long-term repo operations, efficient liquidity management framework for the RRBs, and the GSAP program. So we are quickly going to discuss each of these important tools used by the RBI. So can you see this table here, all of you? Now this particular table shows the revised liquidity management framework. That is what all tools the RBI uses to manage the liquidity in the economy. This revised liquidity management framework was adopted by the RBI in Feb 2020. So as you can see, you have different tools used by the RBI to manage short-term liquidity, long-term liquidity, reserve requirements, open market operations, and tools to influence the yield rates. In that you have Operation Twist and GSAP program. Discussing each of these tools is beyond the scope of this particular class. I will be discussing these tools as part of the prelims revision classes. As far as this economic surveys class is concerned, I will confine my discussion only to those tools which have been mentioned in this year's economic survey. Okay, only those tools I will discuss. Starting with the long-term repo operations, LTROs. Okay. See, most of you know the basics of repo. Repo is a tool used by the banks to borrow liquidity or money from the RBI. So repo is basically a tool which the RBI uses in order to inject the liquidity into the Indian economy. Based upon the duration of repos, repos can be of two types. That is short-term repos and long-term repos. Normally, you must have come across in textbooks or some sources that repo is a short-term tool to manage liquidity, right? Please remember that repo is not always a short-term tool. Repos can be both short-term as well as long-term. Okay. So with respect to short-term repos means the duration of loans. This is less than 1 year, whereas if the duration of loans is greater than 1 year, then we call it as long-term repos. Within short-term repos, you have overnight repos whose duration is equal to 1 day. Then term repos whose duration could be 7 days, 14 days, 28 days, and 56 days. Next, you have long-term repos. Under long-term repos, you have targeted long-term repo operations and special long-term repo operations. So we are going to discuss as to what are targeted long-term repo operations and special long-term repo operations. See, under the targeted long-term repo operations, that is this part, RBI gives loans whose maturity period ranges from 1 to 3 years. The rate of interest on these loans is equal to the repo rate. So they are basically long duration loans. Rate of interest is equal to the repo rate. But the word which is used here is targeted long-term repo operations. The question is, why do we call it as targeted long-term repo operations? Let's understand that. See, what happens under the targeted long-term repo operations is you have RBI. RBI gives loans to scheduled commercial banks as part of these targeted LTROs. Maturity period is 1 to 3 years. Repo rate of interest is equal to repo rate. And then the RBI imposes conditions on these scheduled commercial banks that whatever money they are borrowing from RBI under this particular tool, all that money, it has to give to only certain specified sectors. Only to certain specified sectors the money has to be given. For example, earlier, there was a committee appointed by the government called as KV Kamath Committee. The KV Kamath Committee identified more than 20 sectors which are facing the economic slowdown. And only to those sectors identified by the government, the bank should give loans under this targeted long-term repo operations. That is why we call it as targeted. I hope you're getting this point, right? As far as the difference between targeted long-term repo operations and special long-term repo operations is basically as to who is borrowing the money. In case of targeted long-term repo operations, the money is borrowed by scheduled commercial banks. Whereas in special long-term repo operations, it is the small finance banks who are borrowing the money. So the small finance banks will borrow money from the RBI under special long-term repo operations, and that borrowed money is in turn given in the form of loans to certain specified sectors. So that is the only difference. I hope you're getting this point, right? So we are basically giving long-term loans to certain specified sectors at a rate of interest which is equal to the repo rate. Please understand that. Okay. Next is liquidity management framework for RRBs, regional rural banks. I hope you know the basics of RRBs. Now, if you look at RRBs earlier, they were not allowed to avail the facility of liquidity adjustment facility. That is, they are not allowed to use RBI's repo, reverse repo, and MSF. But now RBI has allowed even the RRBs to have access to the liquidity adjustment facility, LAF. So please remember this from the perspective of the prelims examination. Okay, now this is the most interesting part. See, repeatedly we have studied that the main role of the RBI is to control the rate of interest in the Indian economy. By controlling the rate of interest, the RBI controls the rate of inflation. It ensures that the rate of inflation is between 2 to 6%. That is what we have studied. But what has been happening in the last 1.5 years? Is there any noise interference in the mic? Rimsha? Just give me 1 second. I need to change the batteries. Just give me 1 second. Am I audible now? Still, is there any kind of interference? No, right? Okay. Thanks for highlighting. Okay. So, like I was saying, that normally we have studied that the main role of the RBI is to control the rate of inflation in the economy. But from last 1.5 to 2 years, RBI has been taking certain actions which are considered to be out of box. Because RBI, apart from managing the rate of inflation, it is also trying to bring down the yield rates on the government securities. So it is trying to ensure that the yield rates on the government securities is below 6%. So we are trying to understand as to why is RBI concerned with the rising yield rates on the government securities? Why is RBI trying to bring down the yield rates on the government securities? So once we understand this particular topic, we'll then take up the discussion of what is Operation Twist and what is the government securities acquisition program. Clear? So let's understand this. Now, I hope all of you know that RBI, it is a debt manager of the government. So it is the RBI which issues the government securities on behalf of the government. So let's say the RBI is now issuing a government security, for example. So when it is issuing a government security, new government security, RBI will carry out an auction of the government security. And this auction is carried out on a platform known as the e-Kuber platform. So when it is carrying out this particular auction, RBI will mention only the maturity period and the face value. Only the maturity period and face value is mentioned. For example, here the face value is ₹100 and the maturity period is 10 years. As far as the rate of interest on the government security is concerned, the RBI will invite bids from the investors. So you have, say, 3 investors: investor A, investor B, and investor C. These investors will be required to place the bids in terms of what? In terms of how much interest they are expecting. So logic is very simple. Whoever is asking for least rate of interest in the government security, such an investor will be given the government security, right? So let's say here, investor A is asking for 6%, investor B is asking for 6.10, and investor C is asking for 6.20. Who is asking for least amount of rate of interest? Investor A is asking for least rate of interest. So this government security will then be allocated to the investor A with a rate of interest of how much? 6%. Are you getting this point? Now, the question is, on what basis is this investor asking for 6% rate of interest on the new government security? On what basis is he asking for that? Now, in order to place a bid on the rate of interest on the new government securities, this investor will look at his rate of returns on the existing government security. How much returns is he generating on the existing government security? Based upon that, he will place his bids for the new government security. Now, for example, let's say there is an existing government security. Let's say this government security was issued 1 year back. It has a face value of 100, maturity period of 10 years, and rate of interest is 6%, for example. Now, let's say this government security has been bought by investor A. This investor has bought this government security at, say, ₹110, for example. Okay. What is its face value? Face value is 100. But what price he has bought? 110. So let's apply your CSAT skills here. How much money have you invested? You have invested 110. On this investment of 110, how much returns are you getting? 10, you are getting a percentage. How much? 6% rate of interest. 6% of the face value is how much? 100. So on an investment of 110, you are getting a return of how much? ₹6. Convert this in terms of percentage. For 100 is how much? That's how you calculate your returns, right? That's how you calculate your returns. So if you apply this, how much returns are you getting? You're getting a return of 5.45%. Are you getting this point? So when you are placing your bid, you will take into account how much returns are you getting on your existing government security. If you are getting a higher returns on the existing government security, you will ask for high rate of interest on the new government security. If you are getting low rate of interest, then probably you'll ask for low rate of interest on the new government security. So now let's say on the existing government securities, he's getting 5.45. So what this investor will do is, investor A, he will probably place his bids at 5.5%. For example, are you getting this point? If the yield rates on the existing government security is 5.45, this investor will probably demand for 5.5% rate of interest on the new government security. Let's reverse this. Let's reverse this particular scenario. Let's say this government security, he buys it at ₹90. So how much money has he invested? ₹90. On ₹90, he is getting a return of 6. So for 100, what is the percentage of returns? He is now getting a returns of 6.66%. I'm sorry. Okay. On this, he is now getting a returns of 6. So here he is getting a returns of 6.66%. So when he is placing a bid now, he'll probably ask for 6.7%. So he will place the bets on the new government securities based upon how much returns is he generating on the existing government securities. So if the yield rates on the existing government securities, say from 6%, it has been increased to 6.66%, then this investor will ask for 6%, 6.7%. Now see here, when this government security was issued 1 year back, what is its rate of interest? 6%. Now its yield rate has increased to 6.6%. Investors will ask for 6.7%. Now this government security, what will be its rate of interest now? It will be probably like 6.7%. So earlier government had borrowed money at what rate of interest? 6% rate of interest. But now government will borrow money at how much? 6.7% rate of interest. Can I say my borrowing cost of the government will increase? So that is why RBI has been trying to bring down the yield rates on the government securities to below 6%. So that is what you must understand. So in order to do that, RBI has adopted Operation Twist and GSAP program. So let's understand these two things. I hope all of you know about the open market operations, right? Under open market operations, the Reserve Bank of India will either purchase the government securities or it will sell off the government securities. It will purchase the government securities in order to inject money, especially when there is a recession. It will sell the government securities to suck out the money when there is a inflation. So this is open market operations. Now, if you look at Operation Twist, let's understand this. In case of open market operation, either the RBI is purchasing or the RBI is selling. Simultaneously, both the things are not taking place in case of open market operation. But in case of Operation Twist, simultaneous purchase and sale of government securities is taking place. How does it take place? Let's understand that. See, RBI first and foremost, what it will do is it will sell the short-term government securities. By selling the short-term government securities, can I say RBI will get money? Yes. So let's say the RBI has sold short-term government securities worth 100 crores. By selling these short-term government securities, RBI gets 100 crores. Now the same 100 crores, then the RBI will use to purchase long-term government securities. Now, do you see any kind of impact on the overall money supply? Is the total money supply changing? Money supply is not changing at all, because initially we sold off short-term government securities, got 100 crores, and then once again the 100 crores is injected back. So there is no net effect as far as the money supply is concerned. But what is changing is the yield rates on the long-term government securities. How? Here, RBI is purchasing long-term government securities. As RBI purchases long-term government securities, supply of the long-term government securities is going to come down. As the supply of the long-term government securities comes down, the demand for long-term government securities increases, and hence the yield rates on the long-term government securities will reduce. So that is Operation Twist. When it comes to GSAP, Government Securities Acquisition Program, it is almost similar to the open market operation where RBI is purchasing the government securities. It's almost similar to that. But there's one difference here. In case of open market operation, the market participants, that is banks and financial institutions, have absolutely no idea as to how much government securities the RBI is going to purchase from them, when it is going to purchase from them. But in case of GSAP, RBI gives an upfront commitment to the banks, to the financial institutions, that it is going to purchase certain amount of government securities in a particular time frame. An upfront commitment is given by the RBI. For example, in the first quarter of the financial year, under GSAP 1, RBI had given a commitment that it will purchase government securities worth 1 lakh crore in the first quarter of the financial year. So when RBI is giving an upfront commitment that it will purchase the government securities, can I say automatically demand for the government securities will increase? Yes. As the demand for the government security increases, automatically prices will increase. And as the prices increases, prices and yield rates are inversely proportional, yield rates will come down. Are we clear now? Now, one interesting thing which happens is here, when RBI is purchasing the long-term government securities, don't you think the RBI is injecting money now? Can you see this? RBI is injecting money. Now, just imagine if you keep on injecting money through the GSAP program, can I say the total amount of money supply in the economy will increase? It is similar to quantitative easing, right? Total amount of money supply will increase. And if the total money supply increases, don't you think it may lead to hyperinflation in future? So what the RBI then does is, whatever money it has injected, it will try to suck out this excess money through the reverse repo. So let's say it has purchased long-term government securities worth 100 crores. It has injected 100 crores worth money. So this 100 crores, it will try to suck it out through the reverse repo. So once again, is there any net effect on the money supply as far as GSAP is concerned? No effect. So as far as Operation Twist and GSAP is concerned, the focus is not on injecting money. Please understand that. Focus is not on injecting money. Focus is on controlling the yield rates on the long-term government securities to ensure that the yield rates of the long-term government securities is below 6%. Are we clear now, all of you? Yes. So these are some things which become quite important as far as your prelims examination is concerned. So here I have incorporated all the things. Performance of banks. So in the last year's economic survey, I had discussed the concept of regulatory forbearance. So in case if you're not discussed or if you're not gone through the last year's economic survey, please go to last year's economic survey and understand the concept of the regulatory forbearance. Please understand about that. Okay. Then some prelims pointers on the deposit insurance. So what all things you need to understand as far as deposit insurance is concerned, I have incorporated this in the PPT. Please go through these things. Bank credit, I hope you know, bank credit is in turn categorized into two types. That is the food credit and the non-food credit. When you say food credit is basically the loans given by the banks to Food Corporation of India and other agencies which are involved in procurement of food grains. So here, whichever agency is involved in procurement of food grains, the government is required to pay the food subsidy bill to such agencies. So when the banks give loans to such agencies involved in procurement of food grains, we call that as food credit. Everything else, including the loans that we give to farmers, the loans that we give to agriculture sector, everything else is part of the non-food credit. Only the loan that we give to Food Corporation of India and other agencies for procurement of food grains, we call it as food credit. Please remember this. So the economic survey has basically highlighted as to how food credit and non-food credit has changed. Not really important. You just have to understand the concept of food and non-food credit. Okay. The last topic of this particular chapter is with respect to various steps taken by the government for the resolution of non-performing assets. That is debt recovery tribunals, SARFAESI Act, IBC code, and so on. As far as this particular topic is concerned, I have discussed this topic in the DNS dated 2nd of July 2021. So as you can see in this particular topic, DNS, I discussed the working mechanism of SARFAESI Act. In particular, I have discussed as to what are the differences between the SARFAESI Act and the Insolvency and Bankruptcy Code, IBC and SARFAESI. Then I have discussed the important provisions of IBC. Then I had also carried out a critical analysis of IBC. That is, what are the benefits? What are the challenges with respect to IBC? So if you go through this particular DNS, everything is covered. So I'm not going to discuss this once again. So as you can see, I've discussed the working mechanism of SARFAESI Act. I discussed the working mechanism of IBC, the benefits and challenges with respect to IBC. So please go to that particular DNS. So I'm going to start discussing the next chapter, that is prices and inflation. I would need another 20 minutes from you. Okay. After 20 minutes, I'm done. It's already 1:17. So once again, this chapter happens to be one of the most important chapters. Here, as part of this chapter, first and foremost, we are going to understand the reasons for the rising global inflation, basics about inflation indices, that is difference between WPI and CPI. And this year's economic survey has discussed as to what are the reasons for the growing divergences between wholesale price index and the consumer price index. So if you see wholesale price index, it is at 25-year high of 12.5%, whereas CPI is at 5%. So there is a divergence between WPI and CPI. Both WPI and CPI are used to measure inflation, right? But in spite of that, there's a divergence. So this year's economic survey has discussed as to what are the reasons for the divergence. That is where it becomes quite important. Apart from that, this year's economic survey has introduced a new concept of refined core inflation. Most of you have already studied about headline inflation and core inflation. This year's economic survey has introduced a new concept of refined core inflation, which becomes quite important as far as the prelims examination is concerned. So all of these aspects we will be discussing. Starting with the global inflation, why it has been increasing. Okay. Now this particular graph here shows as to how the inflation across the world is increasing right from Jan 2021 onwards. So right now, the rate of inflation in US is at 4-decade high. That is highest in the last 40 years. The rate of inflation in UK is at 3-decade high. As far as India is concerned, the rate of inflation in India is comparatively lower at 5.4%. But if you look at Brazil, in case of Brazil, the rate of inflation is at double digit of 10.1%. So what do you think are the main reasons for the rising global inflation? Why prices of goods across the globe are increasing? Now you have studied in your foundation classes that inflation takes place whenever there is a demand supply mismatch. So as far as the global inflation is concerned, the reason as to why global prices are increasing is because on one hand, demand has suddenly shot up, particularly after the lifting of lockdown, whereas supply has still not caught up with the demand because of supply chain disruptions. So there is a demand supply mismatch. So what are the reasons for this demand supply mismatch? I hope you can see this particular thing. So broadly, the reasons can be categorized as demand pull factors and the cost push factors. When you look at the demand pull factors, these include faster economic recovery. So most of the countries have seen a V-shaped recovery. So suddenly demand for goods, demand for services has shot up. You must be knowing that countries such as India, we are giving a lot of push to the creation of infrastructure. So creation of infrastructure would in turn need a lot of raw materials, right? Like iron ore, steel, cement, electricity, and so on. So suddenly demand for goods has shot up. Similarly, if you look at China, the manufacturing industries in case of China were closed down because of lockdown. Now suddenly China wants to increase its production. So suddenly there is a demand for more goods. So demand pull factors. Then other factors include the pent-up demand, stimulus measures announced by the advanced economies, increased demand for certain goods such as laptops, mobile phones, etc. As far as the cost push factors is concerned, in the last class we have already discussed that there is a global supply chain disruption. So because of this global supply chain disruption, we are facing a shortage of certain raw materials such as semiconductors. Apart from that, there has been a drastic increase in the prices of raw materials like copper, iron ore, steel, and so on. Further, if you see, last year, most of the OPEC countries had decided to cut down on the production of petroleum goods, petroleum products. But once the lockdown was lifted, they have not increased the production of petroleum in line with the growing demand. So there is a shortage of petroleum, and accordingly, the crude petroleum prices are increasing, which is evident in the rising coal prices, petrol prices, diesel prices, and electricity. And last is that the freight cost across the globe are increasing. So these are the basic factors which have led to the rising global inflation. Now, what is important as far as the prelims examination is concerned is the difference between WPI and CPI and why WPI and CPI are diverging. So let's discuss those things. So please have a look at this table. So in this particular table, I have incorporated all the differences that you need to understand between WPI and CPI. So please focus here. I hope you know the basics of WPI and CPI. I'm not going to discuss that. WPI, it is measured by the Office of Economic Advisor, whereas CPI is measured by the National Statistical Office. The WPI is released on 14th of every month, whereas CPI is released on 12th of every month. WPI covers 697 commodities, whereas CPI covers 299 commodities. Now look at this. Can you see this WPI graph? Okay. Now, as I said, WPI measures inflation in almost 699 commodities. These 699 commodities can be in turn categorized into three different categories. That is primary articles, manufactured products, and fuel and power. When you look at the primary articles, right, this primary articles, this once again, it can be categorized into two types. Primary food articles. So when I say primary food articles, it basically includes rice, wheat, and so on. And then it also includes primary non-food articles. So primary non-food articles include crude oil, petrol, crude oil, then natural gas, then copper, iron ore, bauxite, and so on. So all of these are the primary articles. And look at the weightage here. How much weightage it has? 23% in the CPI. Next, you have manufactured products. Within manufactured products, once again, you have two categories: manufactured food products and manufactured non-food products. And third category is the category of fuel and power, which has a weightage of almost 13%. So this is the weightage of different commodities as far as the wholesale price index is concerned. Now look at this part. This is very, this becomes important. What is the total weightage of food in the wholesale price index? Now where is food covered? Food is covered as part of primary articles, primary food articles, right? Plus food is also covered as part of the manufactured products. What's the total weightage of food in WPI? 24%. If you look at the weightage of food in the CPI, it is much higher at 46%. Almost double. So weightage of food in CPI is at 46%, whereas weightage of food in WPI is 24%. What does this mean? If there is increase in the prices of food commodities, can I say both WPI and CPI will both increase, right? But between these two, which one of these two will increase more? CPI will increase more because CPI has more higher weightage to food, right? Look at the second part, weightage of fuel. When I say weightage of fuel, crude, petroleum, and natural gas, these two, they are included under the primary articles. This coal, electricity, LPG, kerosene, petrol, diesel, they are accounted under this fuel and power. Total weightage is 15%. This is as far as WPI is concerned. But if you look at the weightage of fuel in CPI, this is approximately around 9.5%. So which of these two indices gives higher weightage to fuel? The WPI. So once again, same question. If there is increase in the prices of fuel, both WPI and CPI will increase, but which of these two will increase more? It is WPI. WPI will increase more because it gives more higher weightage to fuel. Are you getting this point? Similarly, if you look at the manufactured non-food products, out of, I said total manufactured products weightage is 64. Out of that, if you take into account only the non-food products, the weightage is 55%. So this is as far as WPI is concerned. Now let's look at the CPI. Can you see here the CPI, Consumer Price Index? So as I said, Consumer Price Index measures inflation in almost 299 commodities. So broadly, it measures inflation in food and beverages, pan, tobacco and intoxicants, clothing and footwear, housing, fuel and light, and miscellaneous category. In the miscellaneous category, what we have is education, you have healthcare, you have transportation, and please focus here within transportation. Specifically, you have petrol and diesel for transportation. Petrol and diesel. Now look at this part. Food and beverages has the highest weightage of 46%, right? If you look at the weightage of fuel in CPI, so if you look, when you see fuel and light, this part, fuel and light, this fuel and light includes electricity, kerosene, LPG, coal, cow dung cake. These components are included under the fuel and light. Whereas petrol and diesel, they are included under this miscellaneous category. So how much is the total weightage there? 7% plus 2.5%, 9.5%. But how much is the weightage under WPI? As I said, the weightage under WPI is almost 15%. Are you getting this point? Yes? Okay. Now let's look at different variants of Consumer Price Index, CPI. See, normally when we say CPI headline inflation, when we say CPI headline inflation is the inflation in all the 299 commodities. So when you measure inflation in 299 commodities, we call it as headline inflation. That's the first thing. Second, CPI, Consumer Food Price Index. Very important from the perspective of prelims. CPI, Consumer Food Price Index. So what is this CPI Consumer Food Price Index? Now, can you see this food and beverages category? In this food and beverages category, we have 12 items. We measure inflation in 12 items. But when we are measuring Consumer Food Price Index, out of these 12 items, we measure inflation in only 10 items. That inflation 10 items, we call it as Consumer Food Price Index. To give you more detail about this, I have incorporated this particular table. Can you see this table here? This table includes all the commodities which are included in the food and beverages category. How many commodities are there? 12 commodities, right? Out of these 12 commodities, when we want to calculate the Consumer Food Price Index, we take into account only these 10 commodities. We don't take into account the last 2 commodities. That is Consumer Food Price Index. Clear? Next is core inflation. Now this is very interesting. See, normally when you say core inflation, right? Theoretically speaking, core inflation means inflation in the commodities which are considered to be non-volatile. So all the volatile commodities will leave out. So which are the commodities which you consider as volatile? Food and fuel. So we leave out food and fuel, and then we measure inflation in all the remaining commodities, that we call it as core inflation. That is what theoretically we have studied in our standard textbook. But how do we measure core inflation in India? Let's understand that. So in case of core inflation, what we do is we exclude food and beverages category, and we exclude fuel and light. These 2 categories we exclude. So we measure inflation in pan, tobacco and intoxicants, clothing and footwear, housing, and miscellaneous. Now problem is within miscellaneous, even petrol and diesel are also included. Transportation part, right? So don't you think that when we are measuring core inflation, we are actually considering the inflation even in petrol and diesel also? Yes. So we are actually excluding food and beverages. This one we are excluding. We are excluding fuel and light. That is, we are excluding electricity, kerosene, LPG, coal, and cow dung cake. But we are including petrol and diesel because petrol and diesel are part of miscellaneous category. Are you getting this point? So how do you solve this problem? You add one more index, you add one more part, and call this as refined core inflation. How do we measure refined core inflation? Refined core inflation is measured by taking out the food and beverages category, by taking out the fuel and light, and by taking out petrol and diesel from the miscellaneous category. How do we measure refined core inflation? By taking this pan, tobacco and intoxicants, clothing and footwear, housing, and all other commodities in the miscellaneous category except the petrol and diesel. That is the refined core inflation. So please remember this, because it has been highlighted in this year's economic survey as to how do we actually measure the refined core inflation. And last and most important is, see, when we measure CPI, Consumer Price Index, it is measured at 3 levels: CPI rural, CPI urban, and CPI combined. For measuring CPI urban and CPI combined, we take into account the inflation in housing prices. For measuring CPI urban and CPI combined, but for measuring CPI rural, housing prices are excluded. So I said housing not covered under CPI rural. Please remember this from the perspective of prelims examination. Okay. Next, you have other variants of CPI. For example, CPI AL, CPI RL, and CPI IW. So please focus here. All of these indices are published by the Labor Bureau under the Ministry of Labor. Other important aspect for the perspective of prelims: CPI agriculture labor. It is linked to the MG Narega wages. CPI industrial workers. It is used to calculate the DNS allowance of the central government employees. Perspective of prelims, it becomes so important. Okay. Then you have some details about food price index, which I think you should be able to read and understand on your own. Okay, now this is the part. Reasons for the divergence between WPI and CPI. Let's understand that thing first. Okay. Let's look at how CPI has got changed. CPI, it has increased from 4.8% to 6.2%. And then from 6.2% on an average, the CPI rate of inflation has come down to 21-22. So CPI has increased and then it has reduced. So let's understand as to why did CPI increase for this particular year. Let's understand that. CPI increased because of higher inflation in food and beverages category. We have already seen that food and beverages category account for 46% weightage in the consumer price index. So if there is inflation in the food prices, the CPI has also increased. In particular, there was inflation with respect to edible oils, inflation with respect to pulses, and inflation with respect to vegetables, particularly onions. So on account of higher prices of onions, pulses, and edible oils, the rate of inflation increased in the Indian economy. You understand this part? Okay. Now then what happened was government took a number of supply side measures to control inflation in these agricultural commodities. Because of these supply side measures taken by the government, inflation has got reduced now. Can you see this? Inflation has got reduced because of supply side measures taken by the government. So what supply side measures has the government taken? First thing, government has created a buffer of onion and pulses in order to check the volatility in terms of vegetables and pulses. Second, as you know, India is one of the largest importer of pulses and edible oils. So India has reduced the import duty on pulses and edible oils so as to ensure that more pulses and edible oils are imported into India at a lower cost and it is made available. So the second step. Third, we have efficiently implemented the Operation Greens. I hope you must be knowing that initially when Operation Greens was launched, it covered only the top commodities, that is tomato, onion, and potatoes. But later we have expanded the scope of Operation Greens to more than 40 perishable commodities. And any idea which ministry is implementing this Operation Greens? Most of us would think that it is Ministry of Consumer Affairs, but please understand, it is not Ministry of Consumer Affairs, it is Ministry of Food Processing Industry, which is implementing the Operation Greens. Important from the perspective of prelims examination. Similarly, you have another scheme called as Price Stabilization Fund, PSF. The Price Stabilization Fund is implemented by Ministry of Consumer Affairs, whereas Operation Greens is implemented by the Ministry of Food Processing Industry. Then we have brought soya meal under the Essential Commodities Act 1955 in order to check the volatility or the growing prices of soya meal. And we have cracked down on black marketing and hoarding in order to check the volatility in the soya meal. So these are the supply side measures taken by the government, because of which the consumer price inflation has come down. But is it still very low? No, it is still quite higher at 5.2%. So why is CPI still higher at 5.2%? What are the main drivers of inflation? Main drivers of inflation is food inflation has come down undoubtedly, but now it is the prices of petroleum products which has been leading to high rate of inflation. For example, right now the main drivers of inflation are two. One is miscellaneous category. Under the miscellaneous category, transportation, which is petrol and diesel, and fuel and light category, which includes electricity, LPG, petrol, diesel, etc. So these are the drivers of CPI rate of inflation. Now compare and contrast this with WPI. Can you see this? Compare this with CPI. CPI increased and then decreased, right? But what has happened to my WPI? WPI decreased, and just like our economy has shown a kind of V-shaped recovery, the WPI has ballooned to 25-year high of 12.5%. 25-year high. CPI initially increased and then reduced, but WPI is showing a reverse trend. It initially reduced and then increased. Question is why? Let's understand that. For that, first we'll understand as to why did WPI inflation come down. What happened to CPI? CPI increased, right? But in this case, WPI came down. Why? Let's understand that. Now go back to our discussion of WPI. And as I said, WPI gives highest weightage to manufactured products, right? And WPI also gives higher weightage to fuel and power. So now if you see as to why WPI declined, was because there was a decline in the primary non-food articles. Primary non-food articles, as I said, it includes crude, petroleum, natural gas. It includes iron ore, copper. All of these primary non-food articles prices had got reduced. And look at the inflation in fuel and power. How much was the inflation in fuel and power? Negative rate of inflation of -8%. Why? Because there was low demand for petrol, diesel, petroleum products. So this had got reduced. Prices of manufactured products, inflation was 2.8%. So here, even though food prices had increased, we saw food prices had increased, and that is why CPI had increased. But in this case, even though food prices increased, it did not have much impact. Because if you see WPI, if you have to calculate, food prices increase like this, but the commodities for which WPI gives higher weightage, this reduced drastically. So net effect was a decline. Are you getting this point? Food prices increase, but the commodities to which WPI gives higher weightage, it reduced. Net effect was decline in the WPI rate of inflation. But now why has WPI increased suddenly? First thing is obviously low base effect. I hope you know the concept of low base effect. So base last year was very low, and that is why suddenly it has shot up. So one is the low base effect. And second and most important is what we are witnessing is the cost push inflation, or in a way it can be considered as imported inflation. Remember, we discussed that the prices of goods at the global level is increasing. Prices of primary non-food articles such as crude petroleum, natural gas, iron ore, copper, steel, etc. is increasing. So automatically the primary non-food articles Look at the rate of inflation now. How much it is? 20%. Last year, how much was it? 1.3%. So can I say that we are facing a double-digit inflation in the primary non-food articles, which includes, petroleum, natural gas, iron ore, copper, bauxite, all of the primary articles that we use for the process of manufacturing. Now, can I say if the cost of raw materials increase, the cost of manufactured products will also increase, and WPI gives highest weightage to manufactured products, right? It gives a weightage of almost 64% to the manufactured products. So look at the rate of inflation in the manufactured products. Last year, rate of inflation was 2.8, but once again, we are facing a double-digit rate of inflation in the manufactured products. Similarly, if you look at the prices of fuel, last year, the rate of inflation was -8, but this year, we are facing a rate of inflation of how much? 31%, double-digit. So this is why the WPI has ballooned to a 12-year high of 12.5%. So can you see this kind of divergence between WPI and CPI? So the reasons for the divergence between WPI and CPI is because of low base effect. It is because of weightages which WPI and CPI gives to different commodities, right? So in order to summarize our discussion, I have incorporated this particular table here. As you can see in this table, I have incorporated as to what are the reasons for the divergence between WPI and CPI. So here, there are basically two broad reasons. One, CPI rate of inflation has come down, whereas WPI rate of inflation has increased. CPI has come down, whereas WPI has increased. There's a divergence. So here I have highlighted as to why CPI has got lowered and why WPI rate of inflation has increased. So that should be sufficient. Okay. Okay. There are some other topics like drug pricing in India and so on. So all of these aspects, as far as drug pricing is concerned, I have incorporated in the mind map here. I hope you can see this mind map. So here I have discussed as to how the drug prices are actually controlled. So with this, the chapter of inflation ends. There are other chapters like sustainable development, agriculture, industry, and social infrastructure. If you look at these chapters, that is sustainable development, agriculture, industry, services, and so on, all of these chapters are very factual questions. They are very factual. It is basically loaded with a lot of facts, figures, and so on. So it's not really worth explaining as far as this particular class is concerned. But that does not mean that I will not be taking up this discussion at all. What I have done here is to make your work easier. I have incorporated everything in the PPT itself. What all things is important as far as prelims examination is concerned. So let me quickly take you through these PPTs so that you have an idea as to what things are important. For example, as you can see, I've incorporated practice questions. What are the Sustainable Development Goals, SDGs? The Niti Aayog Sustainable Development Goal Index, SDG Index, how it is calculated. State of forest in India. So you can see the top 10 countries in terms of forest. So where is India placed? India has placed at 10th position in terms of area under forest. In terms of percentage of area under forest, India is placed at 8th place. In terms of percentage of forest, which country has the highest forest? Brazil, followed by Peru. And if you look at the top 10 countries which have registered highest annual increase, it is China, Australia, and India. So all of these factual things which you need to understand from the perspective of prelims. For example, this is the State of Forest Report 2021. All of these things I've incorporated. India's international efforts for climate change have incorporated. Then as far as the agriculture sector is concerned, you can see here the contribution of agriculture sector, trends, so as you can see, whenever I have incorporated trends also, below this I have made this table so that it becomes easier for you to read and understand. Okay. So all other chapters I have incorporated in the PPT. Wherever feasible, I have incorporated questions also. So I guess you should be able to go to the PPT on your own and you must be able to understand. There's not much of explanation because it is completely factual. Are we clear on this? Okay. So with this, we come to the end of discussion of the economics survey. So we have tried to cover the most important topics as far as your prelims examination is concerned. So as I said, in prelims examination, the themes which are very important are banking and finance, then the external sector and taxation. So these three themes I have covered in much greater detail. As far as the other themes are concerned, I have incorporated this in the PPT and hope you should be able to go through the 6. So in case if you have any doubts, you can now start asking me your doubts.